For more on this April jobs report, let's bring in Robert Sockin, Citi senior global economist, and Dan Gerard, State Street Global Markets senior global multi-asset strategist, joining us here. Dan, let me start with you here on your initial reaction to the numbers we got.
Look, it's a bit weaker than expected, but I think we have to keep in mind that it's still a pretty decent number given where rates are. The average in the 2019 pre-pandemic year, which was a good jobs year, was 165,000. We've just had really great jobs numbers for a while. I think eventually we're going to continue to see this higher rates environment bite. But Chair Powell said he needs a meaningful increase to unemployment, and we're not there at meaningful yet.
And Robert, want to get your reaction as well. What do you think the Fed, as Fed Chair Jay Powell is up this morning looking at these numbers, perhaps has his flip-flops on and trying to figure out, all right, what is the next way that we need to be discussing in the inflation picture as it relates to employment and getting these numbers? How do you think this changes the tenor of what they're looking for in a trend in employment weakening to the point where it actually gets them closer to some of their inflation targets?
Yeah, these are great questions. I want to echo what Dan was saying, which is, and of course, it's just 1 month's data, so we need to see how the prints evolve in coming months. But, even though it came in below expectations, the number is still a decent pace of job gains. The unemployment rate is still at relatively low levels. And there's some good news for the Fed in this report in that they've been worried, as you noted before, that wage growth has been particularly elevated, which is putting upward pressure on services prices. We had the ECI come in not too long ago at a pretty hot reading for Q1. Wage growth looking a little bit better, at least in the headline in these figures. So it could be that these data on the hiring side, while below expectations, may be pointing to a moderating job market rather than a job market that's falling off a cliff. So it could be a job market that's moving into a soft landing. Or it could be a sign that things are about to slow down much more sharply in coming months. So not enough data here to make a definitive judgment on that. But on balance, I think the Fed's going to be happy that wage growth is cooling and maybe some of that heat they saw in the job market in the first quarter is moderating to some extent.
Robert, we're seeing a huge reaction here in pre-trade. Dow futures up roughly 500 points there. I realize you are the economist here, but I'm curious if, sort of the market seems to be taking this as bad news, good news, as in maybe this will sort of put the timeline back on here for the Fed to cut rates. I mean, how do you see that? I know it's just one print, but given the numbers that we've gotten today.
Yeah, absolutely. And maybe, as you said, we heard from Chair Powell. Chair Powell is worried about sticky services inflation, the inflation numbers we saw in the first quarter. So that lower wage growth print might be some good news there, some start of some evidence that they can be seeing that they may be able to lower rates later this year. And at the same time, Chair Powell also said that they're worried that the labor market might be softening. And that's another reason that might lead them to start lowering rates as well. So the combination of those things, that you are seeing that moderation and you're also seeing it on the wage growth side. So both of those things could lead the Fed to cut depending on how they evolve. So that's probably what the market is reacting to. Hopefully, as I said, that these data are moving in a direction that's more of a soft landing, a moderation in the job market and a moderation in wage growth. But we'll need, as I said, more data. But I think that's probably what the markets are reacting to.
And so, Dan, for the markets and the assessment that we've gotten on the back of this print, I mean, we're seeing the futures, as Kiko mentioned, move and swing on this even more into the green. If you're a trader, an investor this morning, and you're trying to figure out, okay, does this trigger any type of massive reallocation or portfolio pivot, what would that be?
Look, I just don't think we're there yet. We're going to see this knee-jerk reaction because people are biased to this idea that we're going to get the soft landing. But in the end, I think that what we're seeing is extreme data. Rates are biting in some places and really not in others because of this post-pandemic normalization that's still going on. So, look, I think we're still in this higher for longer until we get into more of an emergency period. And that's going to mean a eventual more steepening of the yield curve. So I would just be very cautious here of taking on too much risk here. Earnings has been really concentrated in the tech space, and there's still this big expectation that we have a reacceleration of not just earnings, but margins as well going forward, which is going to be tough to achieve.
Robert, looking at sort of the breakdown here in the BLS data, there's certainly been some concern about just where the economy has trended, this unevenness that we have seen. A lot of focus here on, for example, the black unemployment rate. It jumped at 6.4% in the previous month. We're looking at 5.6%, sort of decreased as well. I mean, when you look at sort of into the numbers here, what does that overall picture look like?
Yeah, it's a great question. As Dan was noting, there's been a lot of swings in the data following the pandemic. I would say on balance, we have seen fairly robust job gains throughout this cycle across the board, fairly low unemployment rates when you average through a lot of the data. And now a lot of that hiring that we're seeing is coming through in areas in recent months like government hiring and some sectors that were very hot earlier in the pandemic, like things like restaurants. Some of the data that we're tracking is looking like that might be slowing down a bit. So there have been a lot of swings in the cycle, but on balance, I would still describe this as a fairly tight labor market that's had pretty broad-based gains throughout the cycle, and one where even in areas that look like they had slowed down some, like the manufacturing sector, we've had a manufacturing slowdown for much of the last year and a half. Even there, you've seen a fair amount of job gains in the U.S. So I would say this is a robust labor market, one where layoffs have been quite low, and broadly speaking, you've seen those gains shared across various industries and types of employment.
Just to follow up on that, I mean, as we're looking at the unemployment rate at 3.9%, where do you believe the Fed is going to be watching for that figure to get towards in order for it to feel like it's got a reason, at least based on what they're seeing in the employment situation, to cut?
Yeah, and this is a key question because if you look at their previous forecast, they've kind of been looking for the unemployment rate to rise a little bit to what they see as a more sustainable level. And we're just a little bit shy of where that is now, somewhere around, let's say, a 4% unemployment rate. So I think if the unemployment rate is kind of cruising around these levels or 4%, that, as I said, could still be very consistent with a soft landing. And that's very much what's in their forecast. I think if you continue to see a rise up in coming months and you're starting to get above 4%, then you start to have concerns that at a national level, the SOM rule, which a lot of people track, starts to come into play, where you get a big rise in the unemployment rate relative to its lows from earlier in the year. And that would be a concerning level for them. So I think if you could just hang out at around these levels, I think that they would think they're getting that moderation in the job market and that soft landing they want. But it's a very tricky balancing act because in cycles, when the cycle turns, the unemployment rate tends to turn at the end and tends to turn up very quickly. So it's a very fine line the Fed has to walk.
Yes, Claudia Sahm, the originator of that SOM rule, good friend of Yahoo Finance, and always look forward to talking to her. Always look forward to talking to you guys, too. Robert Sockin, Citi Senior Global Economist, and Dan Gerard, who is the State Street Global Markets Senior Global Multi-Asset Strategist. Gentlemen, thanks so much for taking the time here this morning.